When you open a 529 college savings account, the primary goal is clear: save for education. But for years, one question has made many parents hesitate: what if the money isn't used? Traditionally, leftover funds were trapped behind taxes and penalties. However, recent changes, specifically the Secure 2.0 Act in 2024 and the One Big Beautiful Bill Act in 2025, have added new layers of flexibility. Today, we're looking at how a 529 can now function as both a college fund and a potential retirement starter, provided you navigate the strict 15-year rules and the updated 2026 limits. A 529 plan is a state-sponsored investment account. You contribute after-tax dollars and the money grows tax-deferred. As long as withdrawals are used for qualified expenses, the gains are entirely tax-free at the federal level. While it started as a college-only tool, its definition of education has expanded significantly over the last few years. Traditionally, 529s were a use it or lose it system for education. If you had $20,000 left over after graduation, your only options were to pay a 10% penalty plus income tax to get it back, or change the beneficiary to a relative. It was rigid, which made many parents hesitate to save aggressively. Many parents still don't know that the game changed recently. The Secure 2.0 Act now allows families to roll over unused 529 funds into a Roth IRA for the beneficiary, tax-free and penalty-free. It's a significant policy change designed to reduce the risk of overfunding. But it isn't an open-ended loophole. The IRS has built in several specific guardrails to ensure it's used as intended. Additionally, what makes 2026 unique is the One Big Beautiful Bill Act, signed in July 2025. This law doubled the limit for K-12 tuition from $10,000 to $20,000 per year. It also expanded coverage to include tutoring, standardized test fees, and professional certifications. So, as we enter 2026, the 529 is no longer just for college. It covers a much wider range of vocational and early education costs. Now, let's deep dive into the specific guardrails or limits I mentioned earlier. To qualify for a 529 to Roth rollover, you must meet some non-negotiable criteria. Number 1, the 15-year rule. The 529 account must have been open for at least 15 years. Number 2, the 5-year rule. You cannot roll over any money contributed in the last 5 years. Number 3, the earned income requirement. The beneficiary must have earned income, like a salary or W-2 wages, at least equal to the amount you are rolling over. If they don't have a job, you can't roll the money. Number 4, the annual cap. The rollover is limited by the annual Roth IRA contribution limit. In 2026, that limit is $7,500. You cannot double dip by contributing $7,500 from their paycheck and rolling over $7,500 from the 529 in the same year. Number 5, the lifetime max. You can only roll over a total of $35,000 per beneficiary. Number 6, the same name rule. The funds must move directly into a Roth IRA owned by the same beneficiary listed on the 529. You cannot roll a child's 529 into your own Roth IRA. Now, as an example, let's look at Sarah in 2026. Her parents opened her 529 in 2010. She graduated last year with $30,000 left. Because her account is 16 years old, she's eligible. She has a job, so she has earned income. In 2026, she moves $7,500 into her Roth IRA. She can continue this annually until she hits that $30,000 balance, or the $35,000 lifetime cap. If Sarah hits that $35,000 lifetime rollover limit by age 28, and that money grows at 7% annually, she will have over $600,000 tax-free at age 67, without ever adding another penny. That is the power of starting early. For high net worth families, 2026 allows for superfunding. You can contribute up to $95,000 in a single year by front-loading 5 years of gift tax exclusions. Even if the child doesn't need the full amount for school, the $35,000 Roth rollover provides a guaranteed tax-efficient exit ramp for that capital. Despite all the benefits, there are risks. A major one is the 15-year reset. While the IRS hasn't finalized the guidance, many experts believe changing the beneficiary may restart the 15-year clock. Second, remember that the $35,000 is a lifetime total per beneficiary. Once you hit that cap, any remaining funds in the 529 must be used for education, or they'll be subject to the old tax and penalty rules. Additionally, some states may not follow the federal lead and could still tax these rollovers. Always check your state's specific 529 tax treatment before moving funds. Generally, a 529 makes the most sense if you have a long time horizon, at least 15 years, and you want a tax-free way to facilitate both education and early retirement savings. It's an ideal way to hedge against the uncertainty of future college costs. On the flip side, there are three scenarios where a 529 is actually the wrong move. First is liquidity. Once money moves into a 529, and especially if it eventually rolls into a Roth, it legally belongs to the beneficiary. If you think you might need that capital back for your own mortgage or business, don't put it here. You lose personal access. Second is timing. Because of that strict 15-year holding period for the Roth rollover, the 529 is a poor choice for short-term parking. If your child is already 14 and you haven't started the clock, you won't hit that 15-year milestone until they are nearly 30. Finally, there's priority. A 529 is a supplemental wealth tool. If you haven't already maxed out your own 401k or personal Roth IRA, you're essentially prioritizing your child's future tax-free growth over your own. Put your own oxygen mask on first before you start funding a 15-year legacy project. Before we wrap up, let's tackle the common questions and myths. First, the home state confusion. Many people automatically think their only option is their home state's plan. But here's the truth. You do not have to use your home state's plan. If your state has an income tax and offers a home team incentive, which is a tax deduction on your contribution, then that plan is often your best bet for the immediate tax savings. Some states even have what we call tax parity, where they'll give you that deduction no matter which state's plan you choose. But if your state doesn't have an income tax, you are essentially a free agent. You can shop around for a plan anywhere in the country that offers the lowest fees and the best investment options for your strategy. But remember, the most important thing isn't finding the perfect plan. It's just getting that 15-year clock started. Second, the cancellation fear. If life happens and you need that cash back, you can close the account. You get 100% of your original contributions back tax-free. You only pay taxes and a 10% penalty on the profit. For example, if you put in $1,000 and it grows to $1,100, you only pay the penalty on that $100 gain. You get your original 1,000 back clean. Third, Roth withdrawal myth. Many people think money rolled into a Roth is locked until 59 and a half. The truth is, because these rollovers are treated as contributions, the beneficiary can actually withdraw that principal at any time, for any reason, tax-free and penalty-free. They don't have to wait until they're 59 and a half. Only the future growth that happens inside the Roth IRA is locked until that milestone. Fourth, the shared limit. You can't double dip. In 2026, the $7,500 annual Roth limit is a shared bucket. If your child has a summer job and maxes out their Roth IRA with their own paycheck, you have to wait until next year to do the 529 rollover. You have to pick one or the other for that tax year. Finally, multiple accounts. Can both parents open an account for the same child? The answer is yes. There is no limit to how many 529 accounts a child can have. In fact, mom, dad, and even grandma can each own a separate account for the same beneficiary. While it's often simpler to have one family account, having separate ones can sometimes help with individual tax planning if you live in or move to a state with a per-owner deduction. Also, you might want one account in a safe plan and another in a growth investment plan. Just remember that all accounts for that child share the same aggregate limit, usually around $500,000 to $600,000 depending on the state, and the same $35,000 lifetime Roth rollover cap. Okay, now I'm going to give you one CPA pro tip that really opens up some advanced planning options. If you are a business owner, or even if you have a side hustle where you've set up a management company, you have the option to hire your children for legitimate, age-appropriate work within your business. This is a powerful lever because it creates the earned income your child needs to trigger that 529 to Roth rollover we've been discussing. It's essentially a strategy for tax-efficient wealth transfer. Your business gets a deduction for their wages, and your child gets to jumpstart their retirement with tax-free growth. Of course, every family's tax situation is different, and the rules around dependency and filing can get nuanced. So you'll definitely want to sync with your tax pro for the details. If you're still evaluating your options for 2026, here is how to approach your next steps. Number one, assess your time horizon. If you have at least 15 years before you'll need the money, the 529's new retirement safety valve makes it a much lower risk option than it used to be. If your timeline is shorter, look at more liquid options like a high yield savings account or a standard brokerage account. Number two, compare your state's perks. Before opening an account, check if your home state offers a tax deduction. In 2026, some states have even added matching grants or seed money for new accounts. If your state offers no tax break, you are free to shop around and open an account in any state. Look for the ones with the lowest investment fees. Number three, audit. Existing accounts. If you already have a 529, verify the account open date. Even if you've changed the beneficiary in the past, knowing that 15-year start date is crucial for planning a future Roth rollover. Number four, consider the alternatives. If you want total flexibility and don't care about the education-specific tax breaks, a custodial account, UTMA, or a Trump account, the new 530A, might fit your goals better. The goal for 2026 isn't just to save, it's to save in the bucket that gives you the most exits. Financial tools are rarely set it and forget it. The 529 has evolved from a simple savings bucket into a sophisticated planning instrument. By understanding these new rules, you can make an informed decision on how to best support your family's future. Thanks for watching.